Morning, everyone.
Morning.
Morning, everyone.
Morning.
Thank you for attending session number 12. Is your 401k a house of cards? My name is Todd Roselle. I'm a partner with Blue Rock Financial Group. To my immediate right is Brad Arnold with Limestone Pension. And to my far right is Chris Benfer with Blue Rock 401k Group. Before we get into our presentation, I'm going to let these two guys ask a couple questions and poll the audience a little bit to see who's here. We want to make sure that we're touching on everything relevant to the folks that are here.
Yeah, I think we just want to find out, the structure of our presentation is on case studies. We've got a small case study and a couple of larger case studies that we did. Just wanted to talk about our experiences most recently in tackling, real life situations. Thought that was a better approach than the normal come in and just talk about a bunch of numbers, which has been done a lot of times. So I think we're wondering how many people here are representing businesses that have a qualified retirement plan, and what size. So if you're here working for a company that, say, has 25 employees or less, let me see your hand. Okay. Are they professional companies? Like doctors, lawyers, so forth, engineers? Okay. Okay. Over 25, say, under 150 or 200. I want to keep saying numbers. Exactly. So a couple hundred.
Right.
We've got a couple. We've grown in the last 3 years from like 30 employees to 280 employees.
Oh, okay. Wow.
So our 401k obviously is growing the same. And
okay.
Yeah.
That's great. Yeah. I think you'll hear some.
But I also was an assistant manager in Marriott Communities in the DC area.
Okay. All right.
And I had 200 plus employees.
Okay. All right. Nice. And then any really large companies, any 200 and up.
Federal government.
Okay. Fair enough. Okay. Well, that gives us an idea. I think.
Yeah, it's helpful.
All right. So the topics that we're going to cover today, introductions first, 401ks in 2014, case studies, fiduciary review process, scary words, and it sounds like there's responsibility there. We'll talk about that and what it means. And then also industry trends. So as I mentioned, my name is Todd Roselle with Blue Rock Financial Group. I'm one of the 5 partners at Blue Rock Financial Group. We are a fee-based financial planning firm. So what that means is we charge a fee in order to give advice. There are many different types of advisors who are out there. Some are commission-based. Some are investment-based, where they also earn a commission on the investments. Some are insurance-focused. Our goal in Blue Rock Financial Group is to do holistic planning for the clients, a number of which are business owners. I'm going to let Chris talk a little bit more about that and how Blue Rock 401k Group came to be when we get down to him. Right?
Yeah, so in the 401k area, as far as kind of what's going on in 2014, there are some years where there's a lot of legislation and a lot of tax law changes. Need to make changes to your design, need to get out and communicate a lot of things to employers. But really, it's been very quiet on the legislative front for at least a couple of years in 401k plans. And defined benefit plans also. When we refer to retirement plans here, we're talking about the broad spectrum. But there really haven't been a lot of legislative changes. So most of what's been going on in the retirement plan world has really been regulatory in nature. So we've, within the last couple of years, the most significant news in the qualified retirement plan world has been around fee disclosure. And in the marketplace, both from kind of the selling side as well as the administrative side, fee disclosure has been by far and away the dominant discussion within the industry. And I know, Chris and Todd and I have seen, product vendors really changing their products, mashing down their fees, advisors bashing heads with each other over fees, And two of the important pieces of guidance is a couple of years ago we had the Department of Labor finally implement fee disclosure from service providers to plan sponsors, what we call in the industry 408B2. Sometimes you'll get a notice from somebody that says 408B2, and sometimes you'll just get a summary of fees. But service providers to qualified retirement plans are now required to notify the sponsors of the retirement plans in a clear fashion what it is that they're actually paying and what the services are that they're paying for. Just common sense. And the DOL's still kind of tweaking that guidance, but it's out there. So anybody who sponsors a plan should know or should get, at least annually, some idea of what they're paying. The second piece is participant fee guidance. So participants in participant-directed retirement plans now have to get a complete recitation of what the fees are that they're paying out of their account. So those two pieces of guidance have really dominated the landscape. And with those fee disclosures, what we've seen happen in the marketplace, and that we're going to be focusing on mostly today here, is a real focus on reviewing the overall working arrangements and fee arrangements with respect to a plan. Doing what we call a fiduciary review or a plan review, or what you might see generically as benchmarking. Okay? Benchmarking has become an important term in the retirement plan industry. And Limestone, we administer close to 1,000 retirement plans. Almost all of them are small employer plans, say 100 lives and less is the majority of the work that we do. Small businesses tend to behave like people, and the larger a business gets, maybe the less it behaves that way. I'm not so sure, but small businesses are very relationship oriented. So we don't see a lot of small businesses waking up in the morning and saying, hey, I really need to take my plan out to bid and benchmark it. What happens instead is the small employer is at a lunch and learn, or they're at something like this, or they're at a social event and they're talking to Chris, and Chris says, hey, have you looked at your 401k plan recently? So there's a lot of friction going on in the community around that for small employers, but it's all kind of on an individual basis. Larger plans, we've started finding, actually really don't benchmark their plans any more frequently than small employer plans do, which is, it's been a real surprise to us, I think, to find that some of the larger plans that we work with essentially behave just like individuals. They have a relationship they like, they don't want to rock the boat, they're afraid of the turmoil that might result from looking at something. Believe it or not, they might just like the advisor. They might have a golfing buddy who's their advisor. For a plan that's got $20, $30 million in it, to be selecting their advisor on the basis of, their handicap is, well, it's not good. So anyway, what we've seen is a focus now on benchmarking, fee disclosure, product development. That's what's really happening in 401ks. The only other thing that's of note, in my opinion, is guidance around the Windsor case, which is the same-gender marriage case. The IRS has issued guidance with respect to that. And anybody who's in a qualified retirement plan or responsible for a qualified retirement plan needs to understand that same-gender marriages that are valid in the state in which they were consummated are valid for federal tax law purposes everywhere in the country, even if the retirement plan is maintained in a state like Pennsylvania, for example, that doesn't have same-gender marriages. So that's the only other really important topic.
Brad, do me a favor. You talked a lot about legislation, you talked a lot about rules that are coming down the pike. Give a little bit about your background as an ERISA attorney. So Brad's going to use a lot bigger words than we will because he's a lot smarter. So.
I'll try. I've been in the business since the mid-'80s. Started out at Delaware Guaranty Trust Company in Wilmington. A lot of people are familiar with them. Went to law school, got my law degree, stayed in the consulting end of employee benefits and have been really in private practice since then. Switched over to Limestone in 2007 as a partner, and we've been growing ever since.
And talk a little bit too about what does Limestone do versus what does Chris at Blue Rock 401k do?
Yeah, so Chris at Blue Rock is the investment piece, and what we like to describe is that any retirement plan really has three pieces. There's the investment advisor, who's helping select and monitor the investments and the investment providers and the other service providers of the plan. There's the investment provider itself. It might be an insurance carrier, it might be a mutual fund company, it might be a brokerage firm. That they're usually doing the electronic record keeping for the plan, receiving money, investing in. And then there's the firm that does the administrative work. And that's what Limestone Pension Associates does. We're a third-party administrator. We help design the plans based on the objectives that the employer set. We help create and maintain the plan documents, the legal plan documents. We do the compliance calculations. There are a lot of discrimination tests and calculations need to be done for retirement plans. And we also prepare and reconcile the trust assets and the annual 5500 form, which is essentially a tax filing for the retirement plans. That's our role. It's very technical. We have a more technical role.
Perfect. Chris, can you give a small introduction and also a little bit of background on how Blue Rock 401k came to be?
Sure. So this is my 20th year giving financial advice to individuals, and over time, as we got deeper into the financial planning aspect, with our small and mid-sized business owners specifically, we identified qualified plans as being the most effective tool for those owners to extract wealth from their business. So, not to overgeneralize the classic situation, person starts their business, puts all their money in their business, every extra dollar they reinvest in their business, then they lift their head up and they're 50 or 55 or even 60 and say, oh my gosh, I need a financial planner, how can I play catch up here? And so initially it was really just an add-on, the 401k part of our business, an add-on to our financial planning practice. What happened, I would say maybe over the last 10 years, maybe 7 years, has been that the regulatory, the compliance, the fee disclosure, the fiduciary responsibilities became more and more onerous for our clients that were business owners. And we recognized that there really needs to be a part of our business that focuses just on 401ks. That the old golf buddy, investment guy, insurance guy, banker, whatever it happens to be relationship and reasoning for doing business is just not valid anymore, and that we need to build out our 401k plan practice. And so we've been doing that for the last 5 to 7 years. We currently have in the neighborhood of 60 plans that we service. They range in size from 2 to 2,000. And we work a lot on the plan design. So Brad mentioned that we play the investment role, and we do. But the investments, we're not going to talk a whole lot about investments today. Frankly, the investments are the easy part. It used to be more complicated. Now any quality platform gives you any investment you want. We can build a portfolio. It's not the big factor. What's important is the plan design, meaning the objective and the goals of the plan sponsor, and keeping them out of trouble. So our relationship with Brad and Limestone became close over these past 20 years because of our focus on plan design. Because we would take, and you'll see in our first case study, we would take our business owner client and we'd say, all right, we got to get as much out of this plan as possible. Brad, how can you help us design the plan to do that? So that's really kind of how the relationship works.
Right, and we've seen, remembering that the focus I mentioned recently on fee disclosure, what we've seen for sure in the industry is a real bifurcation in service providers with respect to investments. And firms that are in the 401k business, like Blue Rock, for example, who know how the plans operate, they understand the special unique issues with respect to 401k, they're gaining business, as they should really, because these are very specialized investment products essentially, And then there's still the onesies and twosies, and they're hanging in there. There's still a lot of onesies and twosies, but it's really hard to recommend that a 401k plan work with somebody who doesn't do a lot of 401k business, because you ask them what a 408b2 fee disclosure is and they have no idea. They have no idea what a qualified default investment is. They have no idea even really how to communicate the importance of retirement saving and how the limits and the contributions work in a plan. It's all really important.
So as we move in the presentation, Brad notated that the onesies and twosies, advisors who deal with one or two plans as a kind of an add-on to what they do for their existing financial planning clients, they may or may not realize that the business owner is also a fiduciary. So can you talk a little bit about the responsibilities of a plan fiduciary?
Yeah, I think this is a chart that I came across a couple of years ago, which I think does a good job of talking about the different areas that are important to a plan sponsor. And we'll use that plan sponsor fiduciary term interchangeably. We can go deeper on what it means to be a fiduciary at any point in this conversation. But really, I think, a lot of people, when they think about 401ks, historically have thought, oh, well, it's just about choosing the investment. What's my best large cap growth fund that I can put in my 401k? And I don't mean to trivialize that decision. That's an important decision, but it's also relatively easy, right? It is having a properly allocated, diversified portfolio inside your 401k plan is low-hanging fruit. And if you can't do that, you don't deserve to even be able to spell 401k as an advisor. That's just easy. I think, the other categories that are important, benchmarking. So being able to tell your employees, tell your Department of Labor, tell yourself that you have a regular process for reviewing the plan features, benchmarking. What are we paying and what are we getting? Okay. 408b2, this regulation about having to disclose your services and corresponding costs to plan sponsors was the best thing that ever happened to us. Okay, because what it did was it separated the wheat from the chaff. Here's what you're paying and here's what we're doing in exchange for that. As a plan sponsor that's responsible for $500,000 or $50 million worth of investment assets or anywhere in between, you deserve to know that, and that should be very clear, and it shouldn't be hard for you to pull together. Fiduciary responsibilities. So if I'm a fiduciary of a plan, as the plan sponsor, I have a responsibility to act as a prudent person would in the oversight of my plan. I need to understand the fees, I need to understand the rules. At the end of the day, to sum it up, what I need to have is a process. I need to be able to tell anybody that asks how I made any decision I made. It's as simple as that. It doesn't always have to be the right decision. Okay? I might have the worst fund in my plan ever. But if I can point to why I made that decision and it's something a prudent person would have done, then I protected myself as the fiduciary. And so it's important all about process on that.
Yeah, and cost is not always a factor either. We've seen we see a lot of people that are in a fiduciary position that will make a decision entirely based on cost, with almost an acceptance that trumps all else. Well, that clearly is not the case. There are a lot of low-cost providers that do not have quality. So, when we go in and talk to fiduciaries, in particular, when you get this focus on cost, there has to be a balance between the two.
So then I think the last piece, which I think we all need to remind ourselves about, is, so we have, say we have 57, 58 plans we service. We have thousands of people who are participants in our plan, that have families that are hoping to retire with some level of dignity. And we have a responsibility, I believe, morally, to deliver to them the best chance they can get. And we all read articles about how they don't save, they don't do this, people don't think, so what? That's the hand we've been dealt. I think we all have a responsibility to do our best to make these participants be ready to retire. And that's a real big focus, I think, of any retirement plan. It's why they exist in the first place.
All right. Yeah. So what we're going to do is take a look at 3 separate case studies. The first one is a smaller plan. We're going to talk about some variations within this, maybe how they got to the point where they are. And also, too, what are the things that this person or company should be looking at? So some of the stats on this: 3 dentists, 15 staff, so 18 employees total, $2 million in plan assets. And as Chris had mentioned earlier, the dentist went along and all of a sudden we say, oh, we've got a goal now, we want to look at retirement. How's that going to work? He's behind on savings, all right? He's always been with this local advisor, he's had that relationship for many, many years, maybe adverse to change or even looking under the hood to see what's there. And the design of the plan was not specifically coordinated with the financial plan itself.
Yes, so I don't know, maybe talk about the planning aspect first. This is a very common scenario, though. Right.
Yeah, so you got the older dentist, he started the practice, he's deep into his career, you have the 2 younger dentists, right? None of them have a financial plan, none of them have really done anything but invest their time, money, and energy back into their practice. So we went in, we did a financial plan for all 3, we realized that it was critically time sensitive to try to do as much as possible for the older dentists, where the younger dentists were interested in kind of somehow coordinating this plan with their eventual takeover of the practice. They were less interested in, had less of a need to sock as much money away into the plan. So we worked together with Limestone Pension to say, okay, how can we design a plan that of course is inside the cash flow abilities of this practice, to be able to put as much money away for this old retirement plan, give something to the participants, which is always important, and treat everybody fairly.
Right, and so I'll let you know, these kinds of practices are all different. And again, committed to not getting too much into the weeds on numbers, but almost every professional practice already has a 401k plan. They do, and in fact, the dental community in particular is extremely good at communicating amongst itself with respect to professional issues and service providers. So they all, in addition to having a 401k plan, most dental practices also have an advanced type of 401k plan. They're doing some kind of contributions that are not the same percentage of pay for everybody, okay? And the ability to make contributions to the dentist or one of the dentist owners different from everybody else is usually predicated upon the age of the staff. Okay, that's just how it works. We're allowed to use age as a factor in determining the variation in benefits. So you get an older dentist owner and a younger workforce, you can usually design a 401k plan that has an employer contribution where maybe the dentist is getting 15% of pay profit sharing at the end of the year, and the staff has to get 5%, which seems discriminatory on its face, but we can demonstrate it's not because of their age disparity. Now, what we don't see a lot is we don't see practices that have 401k plans where there's an older owner dentist who wants to save more than the $52,000 that's allowed under the 401k plan rules. We don't see a lot of them looking at cash balance plans, which is a type of defined benefit plan. And while there are certain CPA firms that understand and know the value of cash balance plans, there are a lot that don't. And so what we were able to do in this particular case is add a second plan on top of the 401k plan. That plan is a cash balance plan. And because cash balance plans are defined benefit plans, they don't have an annual contribution limit. It's not how they work. So with a defined benefit cash balance plan, you can have a 60-year-old dentist put an extra $150,000 away on top of the 401k plan. So those numbers are enormous. They're easy to sell. There are some wrinkles to maintaining those plans, but at this point in time, kind of case study-wise, what we're seeing in the small professional practice area is if you've got somebody who wants to put away as much as possible into pre-tax accounts, adding a cash balance plan is something that you really need to be looking at this point. It's not right for everybody, but for certain situations, it is right. This particular group, they ended up having to guarantee a 3% contribution for staff. In fact, in order to generate $159,000 for the owner, they have to give a lot more than that to staff. The 3% is a guaranteed piece that's built in there. But this particular group has 3 dentists. One of them is a son, of one of the other owners. So you've got an older owner, a younger owner, and then kind of a in between the two owners. And that presents really unique design opportunities as well. Sometimes you have to say to the younger owner, look, these calculations revolve around age. You're going to have to wait your time a little bit, and then maybe in 5 years, 10 years when you're older, and now you've got 20-year-olds working for you and you're 40 instead of 30, then you can start benefiting from this piece of the design. That's all part of the consulting work that has to be done. In this case, that's what we did.
You had mentioned, Chris, that the first thing that was done was a financial plan was completed. And many clients don't understand that in these smaller or more intimate companies that it's very important to understand what's going on with the individual owners, to understand what their objectives are. Can you talk a little bit about that? Were there any hurdles that you saw in getting to the 401k plan through the financial plan route?
So I think that next year when you're coming up with your topics, and hopefully business succession will be one of the topics, because it's all tied together. You just can't. There's a web of financial decisions that are all interrelated with the owners of a small medium-sized business. And when anyone is looking to transition out of the business, for many people, it's the first time that they realize, I really need to know what's going on here. And so the financial plan is very logically the first step. Unfortunately, many of us, myself included, think in silos, right? So I got my 401k plan over here, and I got my business over here, and I got my home life over here. And our focus is to kind of look at everything together and make sure all parts are working together as efficiently as possible. So once we start doing the financial plan, and we have the conversation about where you are, the segue into cash, oh, and by the way, here's a way pre-tax to put away another $160,000 is a very easy conversation to have.
Yeah, in a cash balance plan where you've got $150,000 in addition, maybe going into the qualified plan, that can sometimes be part of a buyout strategy. It's a way of transferring money from the practice on a pre-tax basis into the senior document.
And I'll pick on accountants a little bit just because they're here and I want to have fun with them. But talk also a little bit about how sometimes clients in these smaller S-Corp, LLC type companies have their accountant come to them at the end of the year and say, you need to spend a whole lot of money. It's December 30th, December 31st, and you're going to owe $100,000 extra in taxes. Talk a little bit about the importance of educating the accountant and the relationship between the entire financial team.
Yeah, well, from our standpoint, it's important for us to have good relationships with the accountants. So anytime, what I tell the accountants and the clients and the advisors that we work with is anytime you're generating a tax deduction for a small employer that's $100,000 to $200,000, the accountant needs to know about it, and they need to know about it before the end of the year, because if it's a doctor, for example, maybe the accountant might have recommended that they go buy a piece of equipment at the end of the year for a couple $1 million to get depreciation, right? So if they've done that, and then you turn around and say, well, there's a couple $100,000 that needs to be dumped into the retirement plan, they're actually going to be upset at that large deduction. And then the converse is true as well, which is sometimes you can't put as much away as you want to. So I think most of the CPAs that know how these plans work understand that, and there's strong communication. And that's just like I said before, it's important to be working with an advisor that's in the 401k business. It's equally important to have a CPA who understands the retirement plan business, at least to the extent of being able to eyeball what you're doing, understanding what you're doing, and be able to communicate with you about it. It's really important.
Yeah. Any questions about that, though?
This size plan is a very common plan. You're going to see a lot more $2 million size plans than you will, $35 or $40 million plans, which we're also going to get to. And there's a lot of different looks on those $2 million plans. Sometimes they've got 280 employees and they're a growing company. Sometimes it's higher paying individuals who have contributed for many, many years and are on the verge of retirement. So it's very true what Brad said earlier. It's not a one size fits all. type of a recommendation that can be made, because every single plan is different. When you go in, you really want to test the market to figure out what to do for each individual. So, case study number 2. Second generation company, family businesses are fun. Full HR department, $40 million in assets in their 401k plan with 1,600 employees. The 401k was with a bank. That's sometimes very common. The banking has the lending relationship, they've got the deposit relationship. Oh, by the way, can we have the 401k too? The committee, so there's a committee all in of itself in this entire company, which I'll let Chris talk a little bit more about that. And then also, there was a paid fee for fiduciary review. Again, I'll let you get deeper into that.
Yeah, so I'll just talk about how this originated and then let you run with that. This plan got audited by the Internal Revenue Service, and the company ended up having to pay out 70 to 100 grand or something like that, which is not an insignificant sum of money for a $40 million plan. So they were a little upset at that to begin with. They had a CPA firm who was doing the audit of their retirement plan, who's a very good, solid firm, does a good job with the audit work, and they said, hey, maybe you want to have somebody take a look at your plan, give you some advice with respect to it, and that really led, our relationship with that firm led to the fiduciary audit.
So I just have to make this analogy just because I can't resist the like when I'm 46 now, and one of the things that having grown up shocks me the most is that everybody's the same as they were when they were little kids. They've just grown up, right? So when you go back to reunions or whatever, everybody's exactly the same. They're just older, right? And I think what we have found with these cases, which Brad mentioned before, is these plans. This $40 million plan was just a grown-up $1 million plan, right? And it was the same people that had been there 10 years ago when there was $2 million in the plan, and they had the same processes in place, and they turned around one day and all of a sudden they were older. And so when we came in, they were beginning to feel the pressure a little bit of being fiduciaries over a $40 million plan. It had gotten their attention. The audit from the IRS had gotten their attention, and they're like, you know what, maybe we need to do some education. So Brad and I have been, for the last few years, doing fee-based reviews for plans like this. So the committee will hire us for a fee to do a deep dive on their plan. And a big part of that is fiduciary education. Again, remember, the one guy is head of logistics, right? His job is to make sure that the right stuff's on the truck. And because he expressed an interest in investments 10 years ago, he got put on the committee. And he has he's starting to get a little intimidated by his lack of knowledge. So we spent a lot of time in this case kind of educating the committee on what they need to know and what's important. We also began to kind of turn over all the rocks, right? We requested a lot of information, which I have a list at the end. Requested a lot of information about their plan. On the surface, I think they loved it. They loved their plan, right? They loved their provider. They loved the service person at the bank. And
everybody's happy,
right? And and it's a great case of ignorance is bliss, because when we started turning over the rocks, we found some stuff that kind of got their attention a little bit. Yeah. So, and this, by the way, I think applies to all plan sizes.
Yeah, let's talk about some of the things we found. Just to give you, these are, every case is going to produce different things, of course, but some of these things are, again, I think Chris described it as small plan issues that are just larger in a way. So, we got their 408B2 notice, we got their actual fee agreement, and we compared it to the actual bills that they were getting, and they weren't matching. They're actually paying more. Nobody was really looking at it. In this particular case, fortunately, the company was actually paying a lot of these fees instead of the plan paying the fees. It would have been a much bigger deal if the plan was paying the fees and they were overpaying. But it's bad enough that the company overpays fees, and it's bad enough that the bank overcharged them without noticing it for years and years and years.
So what happened is they had amended their contract a few years ago. So they had negotiated to reduce their fees, but the bank never changed their invoicing.
Yeah, another comment at the outset is, you know, if you're hiring a bank that you have a lending relationship with to do your 401k work, you better be hiring them on the basis of the fact that they do excellent 401k work. Okay? It is not a valid fiduciary reason to hire somebody to manage and record keep your 401k plan that they put pressure on you to do that because you have a banking relationship with them. That's just a failure of your fiduciary obligations. Doesn't mean that you can't do it. It just means that you need to have a good reason for why you're hiring that firm. So I'm going to skip over the share class. You're going to talk about that in a minute. Loans. You know, this is a $30 million, $40 million plan. It has around $1 million in participant loans. A huge number of people, huge outstanding loan balance. This firm was charging loan fees based on a percentage of the outstanding loan balance, as if monitoring a repayment schedule on a $50,000 loan is actually more time consuming than on a $2,000 loan, which, oh, by the way, it's not. It's not. The dollars don't make any difference at all. I mean, charging a fee for loan administration on the basis of the size of the outstanding loan balance, I've never even seen it before, but it was a large number that they were paying. We found that really surprising. This particular plan happens to be a safe harbor plan, which, without diving into the details on that, means that once a year, the employer has to issue a notice at the beginning of the year to all of their participants and say, hey, we're going to make a 3% of pay contribution to the plan this year, okay? The notice we looked at was inaccurate in several respects. It had the wrong vesting schedule on it. It had contributions recited in the safe harbor notice that aren't even available under the plan. It really looked like a notice that somebody had just kind of pulled off of a shelf from the last 10 years and had never changed it. Well, we found out that the 401k, the bank, who's a 401k provider, doesn't actually do their plan documents work. They outsource it to another company. So the bank, big bank, doesn't have the resources in the 401k area, the expertise in their 401k area, to actually do their own plan documents and to produce their own notices. And nobody's providing any oversight whatsoever on those pieces of work that are being outsourced to a national company. It's appalling, to be honest. It's appalling.
The kicker on that was that the plan sponsor signed it.
Yeah.
Right? So the bank says, oh, here's what you have to send out to your participant, and they're like, okay, I'll just sign this and send it out. They've been wrong for years.
Yeah.
So to talk about that, there's a committee, right? There's a fiduciary. Who's responsible for that? Who at the end of the day, who's responsible?
Well, I think they're both responsible in that case. I mean, the committees, generally speaking, are focused on investment issues, by and large. There are a number of fiduciaries with respect to plans. There are named fiduciaries, and then there are people who essentially are fiduciaries by virtue of their responsibilities with respect to the plan. Certainly, the named fiduciaries and anybody acting on behalf of the company, they're responsible for monitoring the service providers. And to the extent that the service providers are issuing, just poor, incorrect information, it's on them. In this particular case, it doesn't really change the facts on the ground. It's just embarrassing more than anything else. But that kind of an error can result in a huge financial liability. I'm sure Maria, I'm sure you've seen them. Just one little error can result in an enormous financial liability. In this case, they more or less got lucky, but to have notices like that being accurate is not acceptable. Plan document was butchered as well, which is a separate issue. Do you want to talk about the share class?
Yeah. So just real quick on that page to wrap that up. So the part of that process is to interview they have multiple sites. So we put a call out to the manager at each one of the sites to interview them about how it's working for them. And we're having conversations like, oh no, it's good. They don't come out here, but I sit down with every new employee. I sit down and help them choose their investment.
Right. So you heard that, right? You're a human resources person, right? Not a licensed investment advisor. Really knows by their own admission,
Right.
know nothing about investments, told us that they're uncomfortable with presenting the information, but they get like a canned PowerPoint sent out to all the locations, and they're responsible for doing it.
So, and then, you know, at the end of the day, fees matter. So, real quick on how this benchmarking works. There's averages out there. There's like a book of 401k book of averages that a lot of people point to. They'll say, you know, if you're a $20 million plan with 1,000 participants, this is what it should be paying. That's inadequate because every situation is different. This place has, you know, locations all over the East Coast. They've got, you know, higher education needs for some of their participants, so that's not fair. So the way this process works is it only is effective if you find out what other providers would be willing to do that work for. So we did that process. I'm explaining it a little bit, but we found that they were about 30% over what other providers would be willing to do the process and not make the same mistakes, which is, you know, you get what you pay for. Not always these people are paying too much for this bad. So when you think about the fees inside of a retirement plan, which is, you know, a large relevant factor, there's different components to that. So the simplest is the, you would think would be the investment fees. We're going to talk about that a little bit, but that's like the mutual funds that are inside the plan, right? Somebody picking and choosing the stocks and bonds that are in that fund, and that's relatively straightforward, right? The Growth Fund of America, the management team of that fund is going to be charging X. It is what it is. A little bit more complicated than that. We're going to talk about that in a minute, but that's the investment piece, okay? The second is the platform, okay? We call this required revenue. Okay, Mr. Provider, how much does it cost for you to send statements to the participants, provide the website, provide the platform, be the custodian, kind of all those other factors? That comes down to a number. Okay, you got to peel away a lot of layers to get down to get those people to say it, but that's the only way you can compare apples to apples. Ideally for us, if we're looking at benchmarking a plan, it would be to go back to the current service provider and have them come down. Have them say, you know what, we've been charging over, but you know what, we were just about to call these people and say we're going to reduce our fees. We're willing to reduce our fees by 20%. Then everybody feels good about the fees. Nobody has to make a change. And then the last piece is kind of what you pay your service providers. What do you pay your advisors? What do you pay your TPA? What do you pay the other pieces? So all those things are relatively easy to quantify. The challenge is on the investment side. The challenge is determining what you pay on the investment side. So before you change, so go ahead, change. So the issue there is share classes, okay? So these mutual funds, they all have umpteen different share classes. So who has ever heard of the Growth Fund of America other than the fact that I just mentioned? Anybody ever heard of that? All right, so it's the biggest mutual fund in the world, okay? It is very popular. It's a large cap growth fund. I always use it as an example because a lot of people have typically heard it. So there's a management team that manages that fund that charges X, about 40 basis points. Okay, so 0.4% to pick and choose underlying stocks. What the American funds, as well as Fidelity and Maryland, anybody else who manages funds at all, have done is they've created different share classes. And basically the different share classes take that management fee and they layer up expenses on it. So Todd will go to the next slide. This is a list of all the different share classes for the Growth Fund of America. Okay? So I think there's 12 or 13 different share classes. Okay? So you're getting, as an investor, the exact same underlying stocks in any one of these share classes, but what you're paying ranges from a total of 1.25 down to 39 basis points. Okay? So when we're doing an analysis for these plans, it is very, very hard for a fiduciary that's got another full-time job to have a true understanding of the share classes inside of their plan and what they're paying. I know Brad mentioned this morning, but I asked him to talk about it a little bit. This came up yesterday when you had a presentation with an IRS.
It did, yeah. I was at a conference yesterday in Philadelphia, and there was a speaker from the Department of Labor, and he's not in the enforcement area, but he's in the examination area there. And he said very clearly that plan sponsors need to be looking at their share classes. It's something that the Department of Labor, if they look at a plan they are definitely looking at the share classes, and they're going to expect the sponsor to be able to explain why it is that they offer, share class whatever versus share class whatever. There have been some court cases throughout the country, appallingly enough, as you can imagine, that have had the same fund in their plan with 2 different share classes. The same fund. So it would be like having, share class A and share class R1 of the exact same fund. One of them's more expensive than the other. So you can imagine, what participants who have very little investment savvy, the kinds of investment decision making they're making, with respect to which share class do I go to. So definitely on the DOL's radar.
So I don't want to go too far down that rabbit hole because it's probably one of the more complicated components of doing an analysis of the plan. But we wanted to shine a light on the importance of understanding what you're paying is not the easiest thing in the world. And what you do as a plan sponsor have the responsibility to know. By the way, cheapest share class is not necessarily best share class, right? So the additional revenue that's generated by some of the higher level share classes may be there for perfectly good reasons, like to pay some of the plan expenses. So back to the one takeaway I would have you take as it relates to being a fiduciary is if you can point to a prudent process, you're good, right? We chose the R4 share class because it covers the expenses necessary to give to our provider and our advisor to run a competitively priced plan. Great, we're done. But I think the majority of plans are not like that. The majority of plans are more in the dark about how their share classes work.
So real quick on share classes. So share classes don't exist just in 401k, right?
Now, individuals as well.
So you can get this in a non-qualified account, you can buy it on the internet, you can own this anywhere. There's 16 different share classes. Is there a preferred share class in a non-qualified, non-retirement type account versus a retirement type account?
So we live in this world of like all these different moving parts. I have a bias towards transparency. To me, strip it out. Get down to the cheapest share class you can possibly be. And then if you have an advisor who's giving you advice, pay them a fee. Then you know what you're paying the mutual fund and you know what you're paying your advisor.
We've got about 10-15 minutes left. There are a couple other things we want to make sure that we get to. We're actually going to skip case study 3. And
Let's
do case study 3?
Yeah.
Okay.
Focus on the case study.
Yeah.
And then we'll skip the trends.
Okay.
Okay, so 3, another large plan, we got hired, they were concerned about their fiduciary education level. Just before the fee disclosure rules came into effect, which you probably remember was a couple of years back from my earlier comments, the investment advisor came in and lowered the investment management fee. This is about 3 or 4 months prior to them having to issue a fee disclosure notice. And so one of the trustees of the plan, that kind of ticked off something in her head, and she said, hey, that's kind of interesting that an advisor would willingly reduce their fee 3 or 4 months before fee disclosure rules. And that was an astute observation on their part. So, she reached the conclusion, hey, we need to really figure out what our role is here and take this plan out to benchmark. So, they've got a full human resources department, $35 million in assets, 1,000 participants. Committee was conscientious, but they didn't really know a lot, actually. And they were aware that they didn't know a lot. So, they were working with an advisor, and they had a separate kind of record-keeping company that was handling their things. And so, a lot of the same kinds of things that we found in the other large case study were somewhat similar with this one, but we found some other things too.
So I think these committees are made up of great people, right? They're people that have the best interest in mind, but they all see the world through their own lens, just like the rest of us. And so there was dissension amongst this committee about loyalty to their current advisor. Their current advisor, I said the investment to the easy part, their current advisor, just to give you the fact pattern real quick, met with the committee twice a year to go over Morningstar reports for the mutual funds. There was no plan design conversations, no kind of a lot of the stuff we're talking about now. We did an uneducated committee, and then he got pizza lunch with the participants who everyone would come in.
That's worth $100 grand, right?
He made $100,000 a year to do that. $100,000 a year, and that's money. That company. That's money out of those participants' ability to retire. That's where I started this whole conversation. It's insane. Okay, so we shined a light on that and didn't get maybe the reaction we had expected because there was a relationship with this advisor, a personal relationship with some of the people on the committee. That's why we're very passionate about this. That's just not enough.
Right, and you reduced it to 65.
Right.
And that's worth 65, right?
So I think, back to, to be sensitive to the time pressures. The other issues from a lens standpoint of this committee, which you need to know as the plan sponsor is, we benchmarked, we had other providers come in, and those providers were talking about their technological capabilities to deliver services. We found out that currently in this 1,000-employee plan, there was a woman who hands the statements out to the participants during the day at work. Okay.
They literally don't get sent from the provider to the employees. They go to the company, and this woman walks them around.
So we say this just as, there's a job security. I can see it going on in her head. She's like, well, if I don't get to do that 8 hours a month, what am I going to do? So there was a lot of committee dynamics going on there, which we had to navigate and educate the committee about kind of priorities as it relates to that. I think that they had an IRS audit as well, which really got their attention. Other platforms were willing to come in, mail the participants to savings directly, cut down on their work a lot. It was a 40% differential as it related to fees. One topic I want to talk about real quick is target date funds. They came up in this plan here. So I said before, the investment piece is very common. These committees, all they ever seem to meet about, we keep their minutes, we go back to their minutes, is they talk about the investments. But what they talk about is the large cap value and the international small cap. But then their biggest fund, or their quickest growing fund category is their target date funds. Okay? So target date funds, just quickly, are funds that are specifically designed to mature at or sometimes through your retirement date. They automatically change their allocation through what's called a glide path as you get closer and closer to retirement. It's kind of an attempt to make the investment decisions a little easier for the plan participants. Since recent regulation, I would say that every plan should really have this type of fund in there, at least as a default option. So if I never choose my investments, at least my money goes into something that is appropriate for my age. Okay. So what is really starting to get a little rumble on the horizon is a realization that plan sponsors are not paying any attention as to why they have this particular family of target date funds in their platform. Right, so they'll spend all this time talking about the individual pieces of their small cap fund, which might represent maybe 8 or 6% of all their assets in the plan. But their largest and fastest growing component, which is the target date fund, they just went with the proprietary platform. So I'm with Prudential, I got Prudential's target date funds. I'm with JP Morgan, I got JP Morgan's target date funds. I'm with whatever, I got their whatever funds. And you can see how this grows up, right? Because in the beginning, we just threw it in as a default. We didn't really know much about it. Nobody had track records, so we just put that in there. But now there's $15 million in there, and we can't explain to anybody why we chose those funds. So there needs to be, in an appropriately managed 401k plan, a process that can be pointed to as to why you're using a particular target date fund. And target date funds come in 32 different flavors. We could spend another whole session talking about them. But I think the point I want to get across is, again, ad nauseum, it's all about process. There needs to be a process to the determination of the target date funds.
To expand real briefly on that, there's a third-party software that Blue Rock 401k Group uses in order to be able to show the differences between one fund and another fund and whether they score high or low or anything in between. And that company did a really good job of educating the folks at Blue Rock Financial Group on target date funds. One of the points that they made was that in 2008, when the market completely rolled over, the 2010 target date funds that were out there, so bear in mind, target date fund 2010 means that the employee or participant will turn 65 in 2010, okay, assumed retirement age. There was disparity from a negative 9% return on some funds to a negative 38% return on other 2010 target date based funds. So to Chris's point, this one is a conversation in and of itself, but there's a very, very wide disparity on target date funds, and it's very important that the participants, the plan sponsors, and fiduciaries know and understand what they're putting in front of their participants.
Any quick questions on that?
Quick question. What, you mentioned one had the IRS on, they had to pay $100,000. Are these things that you're talking about is what caused the $100,000 in penalties, or was there other things?
No, they're not. The $100,000 was caused by an interpretation of the plan document that they were doing incorrectly. So it really had nothing to do with it. Most of the investment issues and the fiduciary issues, the kind of the bad guys, so to speak, would be Department of Labor. If Department of Labor was to review a plan, they're the ones that are concerned about the employees and the fiduciary issues. And of course the employees themselves. Most of the suits in this area, lawsuits against plan sponsors, are class action suits by the participants themselves. Like Fidelity's employees sued Fidelity over their own 401k plan. So that's where most of these things come from.
So, 2 case studies, 2 IRS audits. Okay, both we pointed out egregious problems with both of them. One got fined for document interpretation. The other one didn't get fined at all. They basically survived the IRS audit. Department of Labor goes in, completely different story.
Yeah, and Maria Hurd, who's here as an expert also on IRS audits, as am I. If the IRS gives your plan a clean bill of health, it doesn't mean that your plan is clean. Trust me, sometimes they don't find the needle or needles that are in the haystack.
And look at different things.
What's that?
The IRS information request list doesn't really address investments and share classes. It's the DOL information request list that does. So the IRS audit is really more operational and plan document driven than it is fiduciary compliance.
So we have about 5 minutes for questions. We can continue the conversation independently after we get through those 5 minutes. But does anybody have any questions in particular?
I sort of have a question for Chris. And actually for Brad, when Brad said, it doesn't cost more money to administer a large loan than it costs to administer a small loan. So the same is the case to administer plans, basically. And one question, I genuinely have this question. To the extent you know that a platform contains the cheapest share class available to that employer. Just as an example, some of the platforms, the bundle providers, will let you get into K shares when you get to $10 million.
Right.
So within that same platform, why is it okay for a 50-person plan that has $5 million and a 50% plan that has $9,900,000 to be paying the same 0.002 for administrative
to the advisor,
to the platform? So let's assume for now, no advisor, all right, no Brad Arnold. So you have a bundle provider.
Right.
You have 2 50-person plans.
Right.
And one has $5 million.
Right.
And one has $9,900,000. So neither plan is eligible for K shares at this moment.
Right.
They both have their retail share. For that plan, those shares cost you 0.002, basically. Why is there no movement or lawsuit that I've heard so far saying that basically in the case of that provider, every plan with $9,900,000 is paying that much, too much, for that difference?
Right.
You haven't heard either.
I don't know. I don't know either. I think that where I thought you were going with that, which is like our last bullet on our last slide, which is that I think where we're headed is flat fee.
I agree.
Right. I think for advisors, so we charge as a percentage of assets, right? And we charge for smaller plans. So if you have $1 million plan that you need to administrate with 50 employees, we need to make X number of dollars. We usually kind of come up with that with a percentage of the assets, and then every year we come back and say we need to make 100% whatever. For these bigger plans, it's just a flat number.
Right.
right? It's, you know, our services are going to cost $40,000 a year. Here's what you get, and as that plan grows, it doesn't matter.
Is it
I
even
think that's
possible for
relevant.
that plan to have an ERISA account, basically, to pay me, let's say?
Oh yeah, yeah, and well, that's when you get into the share class conversation, right? Because the share classes can spill money into the ERISA account, which can then.
I understand, but in this case, I think the share class is what it's going to be. So to the extent, I don't know if it's possible to make the argument that to the extent the fee is too much because the plan has grown
Right.
to 9,900,000, that there's something else that could be done with those excess fees, like pay the auditor, maybe hire
Right.
an advisor.
Right.
I've never seen it done.
Yeah.
I think it should be possible, but I don't know that it is.
Yeah, and I think, you know, they have to make, all of those companies have to make reasonable decisions about, you know, at what break points they're going to offer different share classes and so forth. And, you know, there are always bands, you know, within which there are inequities at the top and the bottom, but yeah, some of them are really broad.
Right.
I think I can't help but respond that that's why you need an advisor.
I agree.
Right, because the advisor's role in that situation is to negotiate down that fee from the platform.
Right.
And because nobody else is going to, the platforms are just not going to come to you. I mean, you know, one of the platforms, which I won't go into, that we have a lot of plans with, for years, they wouldn't reduce their fees. We would go to them, we'd be like, look, here's what other platforms are willing to do for it. All you got to do is reduce your fees and they'll stay. And they're like, yeah, no, we're not going to go ahead. Okay, that's a business decision they made and we would move the plans. So I can't speak to what's going on in the ivory towers, but what I can speak to is, you know, in a competitive environment, we can drive those fees down.
Right.
One more question.
Mine was a real easy one. And it's
I'll take it.
when you talked about your example of the dentist, okay, and you talked about the cash balance plans, and I was just curious, are those plans are they at risk for having creditors who come to me? You know, in other words, are they not the same as a deferred compensation plan where it's still part of the company and the creditor can grab it? This is a separate thing.
Yep.
And if the dentist firm goes under,
Right.
his stuff is protected.
You're right.
Yep, it's a qualified plan, just like the 401k.
That was the word.
It's protected under federal law. Yep.
All right. Well, we have lunch at 11:45. We're going to have a special guest join us at 1 p.m. It's going to be the governor, so you're welcome to stay for lunch if you'd like to. It's a sponsor appreciation lunch, and there's going to be some things that we're going to talk about regarding the summit and next year's summit. So again, you're welcome to stay. Please help me in thanking Chris Benfer and Brad Arnold.